Hey, it's Michael Saul, but everybody calls me Tiny, so you can too. And this video is market analysis for the week of December 5th, 2016. Specifically, is this the end of year buying opportunity setting up? So let's take a look at the market here. Let's start with the S&P 500. If you watched last week's video, you saw that I was a little concerned with how stretched we were getting. Didn't think it was an all-out crazy sky is falling short setup, but I also didn't think that we were just gonna keep going up and never pull back. So we did start to pull back the I guess the middle of last week. Wednesday we had another new high, but it was short-lived and we sold off, and then Thursday we continued, and then Friday we paused. Now, if you look at where we are just at the previous high from back in August. I do not believe this is all the pullback is going to do. I think that Friday was a pause. Well, I know Friday was a pause candle, but I think that Friday was just a pause ahead of more pullback coming. I think we go to at least the 20 EMA. It's a much-watched moving average. This is the exponential moving average set at 20. But I also think we could even go through this. Now, we do have a small power coil here that broke out. I call it 217. So we could watch that for potential support. And then we even have the 50-day moving average. Again, even if it got down to the 200-day moving average, and using 222 as the high, which it wasn't, and 211 as the low, which it, I'm sorry, not as the low, as the 200-day moving average, which it probably won't be. Even that is just about, 5%? Even less than 5%. That would not be a terrible, horrible correction. It would not be a bear market territory, anything like that. As of right now, I do not believe we are going to get down to the 200-day moving average, but I just want to put it in perspective here, that if we go down to the 20, or we come down to this 217 where this breakout happened, or even the 50-day moving average, it would not be a big deal. Now, a test of the 200-day moving average could shake some trees. And why could it shake some trees? Because that would bring the S&P 500 below the election day low. All right, so here was Monday the 7th. This was the gap and go day. Then it was election day. And then the day after, which is, in my opinion, the more important level here, because this was the gap down that they just bought and took off from there. So the 200-day moving average, I mean, depending on how far it got, because it is dynamic and it is on a nice strong pace, it could likely be below this day after presidential election low. And that could shake the tree a little bit. That could get people, or a lot of it, that could get the people nervous. That could have people going, oh, my, they're going to sell us off to the end of the year. I knew this one. I knew Trump was bad. They're just selling off to make way because they're waiting just to get Obama out. Whatever side you want to take. Whatever side you want to take, that's fine. I'm most concerned with the technicals. I try not to get into the political, gutter, whatever it is, blaming this one, pointing fingers, whatever it is. All right. So those are the levels that I have to pay attention to here. I have to watch that 20 EMA. I mean, yeah, could we hold here? It's possible. It's possible. If we take our Friday's highs and start ripping, okay. I just think this is a pause before more downside. We got the 20, we got 217, we got the 50, and if that 50 goes, watch the 200-day moving average. Now, there are some Fibonacci levels we can watch for also. If we take the Fibonacci retracement, there we go, we come up there, and you have so you have in between the 50 and the 200, you have the 61.8%. I just call it 62 if you don't mind. Let me get rid of 23.6 and put 78.6 and see where that brings us. Okay, so that brings us right around where the 200-day is now. Who knows what the 200-day is will be, is not, we know what it is, what the 200-day moving average will be if we continue lower. Because like I said, this is dynamic. It's a pretty sharp moving average right now. I mean, for the 200-day to be moving like this, yeah, that's usually it's the slowest, and it's pretty fast. I mean, obviously not as fast as the 20, but it's a sharper angle than the 50 has here. So just something to pay attention to there. It doesn't mean much. I'm just saying that it's moving pretty fast, which also tells me that, you know, we're due for more of a correction. Usually the 200-day doesn't move like that. So we're going back a little bit. For some reason, the 200-day isn't populating there, but you can see, oh, it's not as, I mean, this is a pretty sharp angle there. All right, so that's the S&P 500. We'll look at the Dow, even though I don't care that much about the Dow as far as a leading index. Also going to look at gold because I'm getting a lot of requests for gold. Thank you to Mike Swanson, who posted my video on his site, and he has a lot of gold traders and investors there, so I'm getting a lot of questions on gold, so I will talk about that as well, my technical view of it. I'm not really a big fan of the Dow as a leader. It's very overbought, though. Still staying overbought. Let's wait on the NASDAQ, too. Here's the Russell pulling back, and the Russell has a little bit further to go to get to its breakout level, but you do have the 20 EMA before that, and you have a gap. Not necessarily saying we have to get back to that, but there were different levels here with the Russell. You got the 20 EMA, you got this gap here at 127.80, you got this previous high at basically call it 126. Okay, and then you got the 200-day moving average. I mean, yeah, this had a monster move off the election. I mean, the biggest killer move. So, yeah, that would be a nasty pullback if it offset that whole deal. And like I said, I'm not calling for that. I'm just looking one level at a time. Now the NASDAQ, not interested. Already took out and did just about at the I don't know what these blue things are here. I'd like to find out what they are one day, but I have no idea. This was the election low, the day after election low. Sorry, the day after the election low. We closed right at it, at that level. You can see Thursday we were below it, but on the NASDAQ we basically closed right there. So, yeah, I mean, there is a coil here I drew in. It did break out to the upside. I'm going to adjust this a little bit, but it did break. Okay, if it'll let me. There we go. It did break out to the upside of the coil before it came back. So now if it gives way down here, and this could get to the 200-day moving average faster than anybody because it's right at that level. Let's look at the mid caps, kind of like the Russell, a little strong it looks like, but again, overbought, pretty nice push up. Not saying it can't go overboard, doesn't mean it can't go higher. All right, couple of indices to look at. Here's the semiconductors, and I mean, wicked day on Thursday. Held the 50-day moving average and did manage a bounce. Wasn't a huge bounce, but did manage something. But notice that it's right around this congestion area. So if this bounce does not lead to an offset of last Thursday's move, stocks could get back inside of this range, and we have to watch that. Here's the banks. Yeah, banks are still nice and strong. I'm going to go through a couple quick. JP Morgan basically looks like the index. Citigroup. How about Bank of New York? Northern Trust with a big push up and then the pause. How about Zion? Yeah, just a lot of moves. Here's Bank of America. I don't know if I did Bank of America. I know if I did Bank of New York. I already forgot if I did Bank of America, and I'll just do it again. Okay, no big deal. All right, how about Goldman Sachs? Technically not a bank, but can basically act like one. Broker-dealer, index, Morgan Stanley. These are just... Now, nothing saying they can't continue to stand strong. So far, they've been holding up well compared to how the SPY, the S&P 500, is pulling back, so that's a good sign. The semiconductors are one of the reasons that the NASDAQ is acting weak. How about the biotechs? Yeah, biotechs aren't acting so hot either. They still have a little bit to go down before they offset the low from... Wait a minute. Sorry, I'm a little off here. Off from the day of the election, but they're below the low of the gap low day after, right? This gap counts. That's price action. So technically the low of this would be at a minimum the gap, so it's still above it. But the biotechs, which had a sigh of relief that Hillary didn't win because she has a reputation of being so anti-biotech, is already giving it back up. There's one stock I want you to take a look at, Tesaro. It's a biotech, and it is forming a triangle here. Nice gap up in July, and basically doubled from there, even after the gap, which was up, whatever this was, 75% or whatever it is, big gap. And then, so it's in a triangle. Now, of course, you always have to be careful with biotechs. Don't have the time to go through everything in this video, but you have to look at what's coming up. Are there any, FDA stuff or any other kind of releases coming out? Are they doing any? Are they getting any approvals, or is there news expected? So, depending on what they do. But like I said, it's way too long to go over in this video. Also have to look for earnings besides just company announcements and stuff like that. Phase 3 trials, or all this stuff, depending on what it does, right? So anyway, there's one to watch. Let's look at gold. So I'm going to pull up GLD. I could pull up the futures chart, but let's just look at GLD. And very, very oversold here. It looks like it could possibly be starting a bounce, but wow, is that lame. That is so far a very small bounce here. And V reversals, I mean, they're more common on the downside than they are on the upside, but they're rare overall. So I would probably look for a retest down, watch for a potential divergence down here, and see what is going on here. I don't think it's a short right here. I'm not saying, oh, this is a short right here. I'm just a little bit, I'm not really confident that gold is going to get a huge bounce off of this pattern. The GDX, the gold miners, this is the Market Vectors Gold Miner ETF, looks better. And the reason it looks better is there's a base here. Now, again, this is still trying to pick a bottom here. We're below the 50, the 200, the 20. So I'm not looking at this and going, wow, what a buy, the GDXs. No, I'm not saying that. But these, the GDX is oversold. Right, here's the better look at GLD. I mean, look at this move down here. Just oversold and unloved. Everybody was all happy over the summer. Gold was setting up in a continuation, and then just boom. So I always want to pay attention when that happens. So out of the two, out of gold or the gold miners, I would lean to the gold miners. I don't have buy signals in either one yet. All right, and if you're looking for buy signals here, you have to, let me grab a trend line here. You have to start bracketing the action and see if we get a push up. But yet, you don't forget, you have the moving averages coming down at a pretty nice angle. They could come in as resistance. You got the 200-day, which was at a pretty nice angle up here, is starting to flatten out. I mean, look at this move here. Just 12 to 32 in whatever, a couple months, whatever this was, 8 months. And now just rolling back over. Could this be a continuation pattern? Could we break 20 and go lower? Yeah, absolutely. If I throw the Fibonacci up here, and you got to look at both sides. Okay, if you're just coming in and just saying, no, just tell me where to buy it. Just tell me where to buy it. That's not, that's not a smart way to use, to put your money to work. Is just to try to, hey, you know what? I'm just gonna try to only go one way. You gotta look at both ways here. Let me try to edit this thing. I don't know if I'm gonna be able. Okay, there it is. Still, I have a little trouble there with editing the Fibonacci, but it's right at the 61.8% here, which is, call it 20. Okay, call it 20. It's a little bit lower, But if it breaks through there, the next move is down to whatever this is, 16 and 50, 1670, 1660, whatever it is. It's the zone that matters. The exact number, I'm not one of these traders or analysts or whatever that's going to sit there and say, oh, it's going to stop exactly at 32. It's going to stop exactly at 1661. No, you use these levels as zones, and you watch for the price action. How many times have you seen support break through? You think, oh, my goodness, it's a breakdown, and then it reverses. Or you break out, and then, oh, look at this. We're going, like up here. Oh, look at this. Going to new heights. Oh, nope. Okay, that's a pretty nice size decline, too. But if I'm looking at the two, gold using GLD or the miners using GDX, I favor GDX, but you still have to wait for a buy pattern, and you always have to look at the other side here, which is if this breaks 20 and gets going. The reason that this is support, you want to call it the Fibonacci retracement 5. You don't believe in Fibonacci or any of that stuff. That's cool too. I don't argue. I don't argue with anybody. If you don't want to believe it, it's fine. I used to think that Fibonacci was the holy grail and the be-all end-all. It's not. You have to use a lot of things as much as you can to get the evidence that you need in order to determine an opinion. Okay, and then use that opinion to make a decision. So you have the Fibonacci retracement, but you also have this nice congestion here. And this congestion is I like to say it's non-arguable, right? Like if you want to say Fibonacci doesn't work, you want to say moving averages don't work, you want to say indicators don't work, fine, go ahead, argue, go ahead. I'm not going to fight too long with you on that, okay? But it's non-arguable. This was where price was seeking value. It found its value there, and then it moved away from it. You can't argue that. You could, but there's no argument. It's evidence, okay? So that, in my opinion, is more of a reason why we're holding up there. And but if we do break down through here, yeah, look for this down to the low 16s. I can be reached at tiny@attackthemarkets.com. I've gotten a lot of emails this past week. I want to welcome everybody that's signed up for the Attack the Markets email list. I have a lot of cool stuff coming. I am putting together a e-mini trading course for those who are looking to day trade and don't have, maybe they don't have the day trading requirements to trade stocks, which is $25,000 or more, unless you go offshore, which I'm not even going to talk about because I think that's a pretty dumb decision. Or if you just want to day trade but don't want to put a lot of money up, maybe you want to open a smaller account. Maybe your money is in your retirement or in your longer term investments. And of course, if you have a large account, you could still use the same tactics and strategies and techniques that I go over in the course. But it's really any size account you have, even if you have a small account, okay? And the second thing I'm putting together is the daily newsletter. So what I'm going to be doing is I'm going to be doing a daily video newsletter where I'm going to be going over the market, talking about stocks, running a mock portfolio of with entries and stop losses and trailing and talking about everything, and then a weekly video that's going to be on the long side, at least 20 minutes. This one's getting on 20 minutes too, but I'm just giving you a heads up on this, and that's going to be a membership site for both of those. If you want to trade the E-minis, learn how to trade the E-minis, or you already know how to trade the E-minis, you just want to sharpen up your tools, sharpen up your weapons, and then there'll be a nightly video newsletter, okay? So more on that as it gets close. I will speak to you in next week's video. Again, drop me an email if you want to say hi or have any questions. Have a great trading week.